There is an account available to millions of Americans right now that is better than a Roth IRA, better than a 401k, and better than any other tax-advantaged account in the U.S. tax code. You probably have access to it. You are almost certainly not using it correctly, and the people who designed it, the employers, the insurance companies, the financial institutions administering it, have absolutely no financial incentive to explain to you how powerful it actually is, because the way most people use it generates significantly more revenue for them than the way you should be using it. The account is an HSA, a health savings account. And before you click away because you think this is a video about saving money on medical bills, stay with me, because what I'm about to show you has almost nothing to do with medical bills and everything to do with building tax-free wealth that the IRS cannot touch in ways that no other account in existence can match. My name is William, and by the end of this video, you will understand why every fee-only financial planner who works with high-income clients prioritizes the HSA before almost everything else, and why that advice almost never reaches the people who need it most. First, what an HSA actually is versus what most people think it is. Most people who have an HSA treat it like a flexible spending account, a place to stash money before paying medical bills, emptied regularly, never accumulating meaningful balance, generating modest tax savings on healthcare costs they were going to pay anyway. That is the least valuable version of this account. It is also the version your employer almost certainly explained to you during open enrollment in a 12-minute benefits presentation you attended while thinking about something else. Here is what an HSA actually is. The HSA is the only account in the U.S. tax code with a triple tax advantage. Contributions go in pre-tax, reducing your taxable income in the year you contribute. Growth inside the account is completely tax-free. Withdrawals for qualified medical expenses are tax-free. No other account does all three simultaneously. The Roth IRA gives you two. Contributions are after tax, growth is tax-free, withdrawals are taxed as ordinary income. The traditional 401k gives you two from the other direction. Contributions are pre-tax, growth is tax-deferred, withdrawals are taxed as ordinary income. The HSA does all three simultaneously, legally, with no expiration on the funds and no required minimum distributions. At 65, the HSA becomes functionally identical to a traditional IRA for non-medical expenses. You can withdraw for any reason and pay ordinary income tax exactly as you would with a 401k. But for medical expenses, which represent one of the largest categories of spending in retirement, the withdrawals remain completely tax-free forever. This is not a technicality. This is the most favorable tax treatment available to any retirement savings vehicle in America, and almost nobody is maximizing it. The 2026 contribution limits, the number you need to know. For 2026, the HSA contribution limit is $4,300 for individual coverage and $8,550 for family coverage. If you're 55 or older, you can contribute an additional $1,000 as a catch-up contribution. To contribute to an HSA, you must be enrolled in a high-deductible health plan, an HDHP. The IRS defines this as a plan with a minimum deductible of $1,650 for individuals or $3,300 for families in 2026. If your employer offers an HDHP option and you're generally healthy, the math on switching to qualify for HSA contributions frequently favors the HDHP, even after accounting for the higher deductible, because the tax savings on maximum HSA contributions plus the typically lower HDHP premium can exceed the deductible differential. Run that math specifically for your situation before open enrollment. Most people don't. Most people choose their health plan based on premium and deductible numbers without calculating the total cost of each option, including the tax value of HSA eligibility. That calculation frequently produces a different answer than the surface comparison suggests. The strategy nobody tells you: pay medical expenses out of pocket. Invest everything. Here is the specific behavior that separates people who use HSAs correctly from people who use them like flexible spending accounts with slightly better tax treatment. Do not use your HSA to pay current medical bills. Pay those bills out of pocket from your checking account.
Contribute the maximum to your HSA every year. Invest every dollar of it in low-cost index funds inside the account. Let it compound. Keep every receipt for every medical expense you pay out of pocket and withdraw the reimbursement years or decades later, tax-free for any qualified medical expense you've ever incurred since the account was opened. There is no time limit on HSA reimbursements. The IRS does not require you to reimburse yourself in the year the expense occurred. You can pay a medical bill in 2026, keep the receipt, leave the money invested for 20 years, and withdraw the reimbursement in 2046 completely tax-free, while the invested funds have been compounding the entire time. This transforms the HSA into a tax-free investment account with an unlimited future withdrawal mechanism attached to it. Every medical expense you pay out of pocket is a future tax-free withdrawal you've earned the right to make at whatever point is most advantageous to you, which is almost never the year the expense occurred. A family that maximizes HSA contributions starting at 35, invests in a total market index fund, pays all medical expenses out of pocket, and retires at 65 has accumulated approximately $800,000 to $1 million in tax-free funds that can be withdrawn tax-free for the healthcare expenses that represent the largest spending category in most American retirements. The average American couple now needs approximately $315,000 in today's dollars for healthcare costs in retirement. The HSA investor funds that entire figure with tax-free dollars, while the equivalent cost for someone without an HSA comes from after-tax retirement income.
The investment problem. Why most HSA balances earn almost nothing. Here is where the financial institutions administering HSAs generate the revenue that your account should be generating for you. Most HSA administrators default your contributions into a cash account, earning 0.1% to 0.5% interest. The money sits there, earning essentially nothing while inflation quietly erodes its purchasing power and the market compounds without it. Some administrators require a minimum cash balance, typically $1,000 to $2,000, before allowing you to invest any portion in market funds. That minimum sits in cash, earning nothing, as the institutional equivalent of a cover charge for the privilege of investing your own money. Some administrators offer investment options with expense ratios that would be embarrassing on any other platform. 0.5%, 0.75%, 1% annual fees on funds that track indices available elsewhere at 0.03%. Over 30 years, the difference between a 0.03% expense ratio and a 0.75% expense ratio on a maxed HSA is not a small number. It approaches $100,000 in foregone returns at historical market rates. The solution is to know your administrator's investment options and expense ratios before you accept the default. If your employer's HSA administrator offers poor investment options, which many do, you can contribute through payroll to capture the FICA tax savings, then roll the balance annually to a self-directed HSA at Fidelity or Lively or HSA Bank, where low-cost index fund options are available and minimum cash balance requirements are lower or non-existent. This is called an HSA rollover, and you are entitled to do it once per year without tax consequences. Most people who are stuck with a poor employer HSA administrator don't know this option exists. Now you do. The FITA advantage. The tax savings most people miss entirely. When you contribute to an HSA through payroll via your employer's automatic deduction, those contributions avoid not just federal and state income tax, but also FICA taxes, Social Security at 6.2%, and Medicare at 1.45%, a combined 7.65% that Roth IRA contributions do not avoid. On a $4,300 individual contribution, the FICA savings alone are approximately $329. On $8,550 for family coverage, approximately $654. These are real dollars saved that a direct contribution to an HSA made yourself rather than through payroll does not produce.
This means the correct procedure is to contribute through payroll when possible to capture the FICA savings and then roll the balance to a better administrator after the contributions clear if your employer's platform has poor investment options, which many do. You get the FICA advantage at contribution and the investment quality at the administrator level. Who should and shouldn't prioritize the HSA? The HSA strategy works optimally for people who are generally healthy, can afford to pay current medical expenses out of pocket, have enough income to benefit meaningfully from the tax deduction, and have a long enough investment horizon for the compounding to be significant. It is less optimal for people with high current medical costs who cannot afford to pay expenses out of pocket and let the HSA compound, because the fundamental strategy requires leaving the HSA balance invested rather than spending it on current health care. If you have ongoing significant medical expenses that genuinely cannot be paid from other sources, the HSA is still valuable for its tax advantages, but the investment strategy described here is not available to you in the same form. For everyone else, the generally healthy 30 to 55-year-old with an HDHP option available, surplus cash flow, and a long investment horizon, the correct prioritization in most financial plans is employer 401k match first, HSA maximum second, Roth IRA third, additional 401k fourth. The HSA goes before the Roth IRA because the triple tax advantage outperforms the double advantage at the margin, particularly for high-income earners in higher tax brackets, where the upfront deduction is most valuable.
The retirement healthcare math. Why this becomes the most important account you own. Fidelity's 2025 retiree healthcare cost estimate puts the average healthcare cost for a 65-year-old couple retiring today at approximately $315,000 in today's dollars across their retirement. That number has increased every single year for the past decade, and there is no credible forecast suggesting it will decrease. $315,000 in healthcare costs withdrawn from a traditional IRA or 401k is not $315,000 out of pocket. It is $315,000 plus the ordinary income tax on every dollar of withdrawal, which at standard retirement income levels adds 22 to 24% to the actual cost. The real out-of-pocket equivalent for someone funding healthcare from a 401k is closer to $400,000 to $420,000. The same $315,000 withdrawn from an HSA for qualified medical expenses costs exactly $315,000, zero tax. The HSA investor saves $85,000 to $105,000 in taxes on the same healthcare costs, funded by the same dollars that were invested in the same index funds, purely through account selection. That is not an optimization at the margins. That is a six-figure difference produced by one enrollment decision made during a 12-minute benefits presentation most people give half their attention to. What to do this week, specifically? First, determine whether you're enrolled in an HDHP. If yes, you're eligible to contribute to an HSA. If no, check whether your employer offers an HDHP option at the next open enrollment and run the total cost comparison, including the tax value of HSA eligibility, before you default to the lower deductible plan. Second, if you have an existing HSA, log in and check where your balance is invested. If it's sitting in a cash account earning under 1%, find out what investment options are available and what the minimum balance requirement is to access them. Move everything above the minimum into the lowest cost index fund available. Third, if your employer's investment options are poor, research an annual rollover to Fidelity HSA or Lively, both of which offer zero-fee accounts with access to low-cost index funds and no or low minimum cash balance requirements. Fourth, start keeping receipts for every out-of-pocket medical expense from this point forward, every copay, every prescription, every dental bill, every vision expense. Every receipt is a future tax-free withdrawal you are earning the right to make. A simple folder, physical or digital, is sufficient. The IRS does not require you to submit receipts to claim HSA reimbursements. You simply need to have them if audited. The 12-minute benefits presentation didn't tell you any of this. It wasn't designed to. It was designed to get you enrolled in a plan and move to the next slide. The HSA is the most powerful tax-advantaged account available to most Americans. The triple tax advantage is real. The investment strategy is legal and documented. The retirement health care math is significant enough to be worth 20 minutes of your attention during open enrollment. You have the information now. The enrollment window is the only thing standing between you and the most favorable tax treatment the U.S. tax code offers. Don't give it 12 minutes of half attention this year. The IRS built the most powerful retirement account available and put it inside a benefits presentation nobody fully reads. Now you've read it. Subscribe for a new video every week and drop in the comments whether your employer offers an HDHP. I'm curious how many people have access to this and don't know it.